Hello, I'm Mark Apsey, Head of Indexing at thematic Research, and welcome to the week ahead. What a week it is, and quite frankly, I think we're going to have even more fun, let's say, in this coming week ahead. So, just to do a quick recap of last week, not that we necessarily want to relive it. Essentially, we started out the week thinking, oh, we're going to get some nice updates on the consumer. That's going to be good. So far, earnings overall has actually been pretty positive. There's been a little weakness in tech. Alphabet came out a couple weeks ago saying, oh, AI is expensive. Okay, fine. We really didn't see other companies report along those lines. Amazon came out and did say, well, they didn't attribute it to AI specifically, but the overall gist of it, or what people took away, was that it was AI spending that was hitting them, and so we saw some tech weakness there. Intel, of course, came out. They completely fell out of bed. Some might say they may or may not have done something in the bed before they fell out of it. But clearly there are some internal issues there, especially following the company's announcement of 15,000 layers scheduled to be workers scheduled to be laid off. So lots of tech weakness last week that bled over into other sectors. Now, what also happened was we had a soft PMI print. Okay, that came out on Thursday, and I'm just going to talk about that a little bit. We have talked about in the past about the difference between ISM and S&P/market. The number that came in soft was the ISM number. Okay, and that is relatively important because there are methodology differences in both numbers. Right, the ISM number came out; it was about 2.5 points shy. The S&P number came out. Believe it or not, it actually had an upside surprise. It was only zero point 0.1 points, but it was still an upside surprise. Now, the difference between the two methodologies is twofold. One is that when ISM surveys companies, they are accepting responses only from individuals with certain titles. Okay, so they're looking for specific titles of people. Now, if you're a mid-sized or small-sized company, you may not have a hierarchy that requires you to have a chief XYZ officer or whatever. And as such, a lot of those smaller and mid-sized companies just don't get responses put into the ISM number. Now, the other one is that ISM, unlike the S&P market number, does not strip out any foreign operations, any results from foreign operations. So when you look at the ISM number, what you're looking at is a number that is skewed towards very large multinational companies and also skewed to a more global view. Okay, and that's kind of playing out a little bit of what's happening now as Asian markets open. So the S&P number, the S&P market number, wider range of size of company, and also, which is important for this point that I'm trying to make, U.S. centric, right? So there's no foreign operations included or considered in the S&P market number. Okay, so PMI came out soft. People didn't like that. I get it. It's a manufacturing number is soft. Nobody likes that. But the point is that ISM number, more global in nature, much larger companies. S&P number, U.S. centric, wider range of size of company. Okay. Friday came out, of course, unemployment. That's when it really hit the fan. The so-called Solemn rule was triggered, which is to say that I think the trailing 3 months average of unemployment, if it's lower than the 12-month low by more than 50 bips. If it's higher, if the 3-month trailing average unemployment is higher by 50 bips than the 12-month low, or the low over the last 12 months, then what the rule says is that the economy is in a recession. It's not like a harbinger of, hey, we might go into a recession, like we see with a year or so ago, we had two consecutive quarters of down GDP. Everyone thought, oh, well, great, we're in a recession. No, we weren't. The yield curve's been inverted now for what, like 18 months or something. Again, a harbinger, not a solid sign that we're in a recession. The Somme rule, states that if this is triggered, then we are definitively in a recession. Now, of course, what's interesting is that of the 11 or so recessions we've had since World War II, it's been right 9 of the times. And when I say it's been right 9, it doesn't mean that the other two were wrong necessarily. It just means that the other two were periods when the rule was triggered, but we were not, in a recession, but we did enter one shortly thereafter. Now, another thing that's interesting, of course, is that the creator of the Somme rule, Claudia Somme, there was an article where she was quoted as saying, effectively, I have faith in my methodology and I trust the number, but believe it or not, I believe this time is a little different. And in the article, she talked about how, she mentioned households, she mentioned essentially the consumer and kind of the strength of the consumer there. And that actually ties in a little to when you look at model results from last week as well, because models got whacked with everything else, right? Our hedge model had a great week, unfortunately, but it was up about 9%. But of the models that were also positive, they all share the same trait of having consumer exposure, right? So when we look at those positive returning models from last week, our guilty pleasure model up about 1%. Aging of the population, again, up about 1%. The core holdings model, which does carry a fair amount of consumer exposure in it, up 1.25%. And even cash-strapped consumer, although it was close to flat, was technically up about 4 bips. So, there is some strength in the consumer. That's kind of brought out by the numbers. When we look at broader sectors from last week as well, it's kind of interesting. Unsurprisingly, utilities won the day, right? It was up about 4.3%. Now, when I talk about sectors, I'm really talking about the spider sectors, ETFs, right? So we use those to gauge what the sectors are doing. And so utilities up about 4.3%. Interestingly, the second highest was real estate, and that piqued my interest because honestly, I've been seeing more and more stories about how commercial real estate is just coming under so much pressure. Stories of $300 million buildings selling for 40, 50 million, and all those kinds of things. Now, I did do some attribution analysis on XLRE, right, which is our proxy for the real estate sector. And 60% of that 2.8% return can be attributed to 3 specialty REITs, and the specialty they are in is data center and transmission, right? So digital infrastructure, right? Digital infrastructure kind of carrying REITs, carrying the real estate sector at this point. Looking further in the top 10, names like Iron Mountain pop up, public storage, right? So, not necessarily kind of property for property's sake, if you wish, but these specialty REITs are starting to come out. Further in the digital infrastructure side, SBA Communications, Digital Realty Trust, right? Other names in those top 10 really kind of pushing real estate higher. Okay. So, last week again was a tough week. We kind of got a bit of a shock, although people who were tracking the some indicator would say, well, we saw it coming. It was kind of creeping up, and it was. That unemployment jump from 4.1 to 4.3 really is what kind of took everything over the edge. So, looking at this coming week, right now, there's a minor meltdown going on over in Japan. If you talk to a lot of folks at this point, they're talking about the carry trade unwinding and some, the effects that's going to have on broader markets, right? If I look at futures right now, it doesn't look like it's going to be a happy open for anybody. VIX is the August contract for VIX is trading at a 24 handle. It closed on Friday around 22 and change. Um, S&P 500 E-mini down about 1.4%. The Dow E-mini down about 90 bips. NASDAQ E-mini down over 2%. So, I think that when you look at that, and this has been a theme in a lot of our writing as well. What's your tech exposure? And it's pretty much almost week over week this year. The more tech exposure you had, the better you did. Occasionally, the less tech exposure you had, the better that you will do. And honestly, looking at the week ahead here, that is going to play out, I believe, over the week where you're going to see, kind of non-Mag 7, non-tech exposure models, portfolio strategies do well, do better, relatively speaking, than those with more tech. Okay. Um, Looking and thinking about, Wednesday's Fed meeting, and I thought it was interesting the language that Powell used in talking about things, especially where he said that we're data dependent, but we're not data point dependent. And I think that that's pretty interesting because, of course, the market, seems sometimes is a little myopic in terms of, oh, a number came out, and so something's going to happen, right? So, like Friday's number came out, and prior to that number coming out, there was an 11% chance, or the Fed funds futures curve had priced in about 11% chance of the Fed going 50 bips on its September meeting, right? Um, by Friday close, and today, Sunday evening, that's up to 74, 75%, right? Um, I think if we know the Fed at this point, we know that they're kind of going to say what they're going to do, right? They do what they're going to say. So, in as much as yes, the SOM rule got triggered, there is some distress in Asia right now. Um, I Powell said what he said, right? He said, "Hey, we're seeing good news on inflation. We're seeing we're okay with the news that we're seeing on employment." Um, and honestly, I don't know that I see that SOM rule or even the PMI number is going to be enough to sway them to jump to 50 or to take even early intervention or anything like that. So that's last week. Again, this week, more tech pain. We are going to get some more earnings, right? I don't know that what happened last week is going to influence the earnings that we've been getting so far. Like I said, tech has come under some pressure with earnings, but honestly, the rest of the sectors have actually been doing okay, right? So we'll look for that to continue. Lots of tech pressure, you know, ugly open tomorrow, and we're basically gonna have to see what happens with that. We'll see if what's happening in Japan now is going to spill over, and where and how much it is going to spill over to. So that's pretty much it for now. Like I said, we're keeping an eye on our models. We are looking for more consumer strength, or at least relative strength, to help kind of carry markets. And that's about it. So thanks for watching, and we'll see you next week.